Two stocks I'm buying at the right price. This is a video that I don't do very often, but I mainly do it whenever I feel like the market is overextended, whenever I'm looking everywhere and I can't find any decent buying opportunity. I'm not saying there's no opportunities. Google might be an opportunity, some opportunities amongst dividend stocks, but I'm not seeing an amazing opportunity. Like Monish Pabrai says, when some like a 2x4 hits you on the head, like this is like the best buying opportunity. I'm not seeing anything that I'm just dying to own and I can't wait to own it. I'm not seeing any of that stuff in this market. So what I tend to do, I try to be one step ahead of the curve and I start researching stocks before they get to my fair value. I just research stock on the weekend, have fun with them, and then I set price alerts on my fair value. And you could do that for free on Yahoo Finance. And a lot of people don't take advantage of that stuff. I made so much money with those price alerts and it's 100% free. Like one stock last year was Otis Elevators. I was waiting on it for 2 years. And that's why I'm the patient investor. I can wait. I'm not overpaying for some stocks. I waited 2 years on Otis Elevators. And then I set my price alert. I forgot about it. But then all of a sudden, they reported earnings out of nowhere. The stock sold off 17% in the morning in the first 5 minutes on the open. 17%. I immediately got alerted on my phone. I did some quick research. I bought the stock. In the afternoon, it was like 2 or 3 in the afternoon, I was up 12-13%. It just an overreaction. It recovered and ended up selling the stock for 27 or 28% gain in 2 or 3 months. And this is just an example of trying to stay ahead of the curve and prepare for such things. Do research beforehand instead of us having a crash or having a pullback and you're confused and lost and you don't know what to do. Just don't be in this position. And that's going to be very helpful. And I'm going to share those two stocks with you today. And the first one, this is a stock I've always wanted to own, and it's Microsoft. I'm not an index investor. Most of my stocks, like 90%, are outside the index. That's why I get different returns. That's how I made 27% in 2022. Most of my stocks are outside the index, and that's just how I like it. But Microsoft is a stock I've always wanted to own. It's been pretty much flat over the last year. It's up like 10%. Underperforming other stocks, and we might be getting this opportunity soon, and that's why I'm getting so excited, because now the FTC is suing Microsoft. I just love it. Every time the FTC sues a company, the stock goes down. This is normally a generational buying opportunity. They never get back to once the FTC lawsuit was announced. You could look at Visa, which is a stock that I own, and other stocks. Whenever they get sued by FTC, this is the time to buy them. I mean, it's been the best trade of 2024, and it's just happening again, and I'm not surprised. And we're going to find out if that changes with the new administration and what could really happen. But yeah, they're getting sued by the FTC, monopolistic stuff, cybersecurity and AI and software licensing and all that kind of stuff. And that could be a catalyst for Microsoft to reach my fair value. And that's why I'm getting so excited. Now, if you look at the PE ratio of Microsoft, it's trading at 32 times earnings. 32 times earnings, to a lot of you believe that's like bubble valuations and it's extremely expensive. Being honest, 32 times is not too expensive. The main reason you believe it's expensive is because in 2017, it was trading at 20 times. And now trading at 32 times, which makes people believe that Microsoft is overvalued. But investing isn't so easy. It's not like 1 + 1 = 2. So yes, it was trading at 20 times in 2017 or 2016. Now it's trading at 32 times. But what else has changed? The company now has much higher return on capital. It was 15% in 2017. Now it's 29, almost 30% in 2024. This warrants a multiple expansion. We used to have much lower net income margins. In 2017, 2015, net income margins were 23%. They went from 23% to almost 36%. This is a huge difference. This also warrants a multiple expansion. Microsoft having potentially higher growth in the future, 15 to 17%, average earnings per share over the next 5 years. I could easily see 15%. With the AI tailwind, which they will likely be dominant in, and with many different things that they're trying to do, those are very different things that weren't present in 2017 or 2018. So the truth is, 32 times earnings for Microsoft isn't overvalued, but it's not cheap either. Like, it's not expensive, but it's not cheap either. And there's a potential for a multiple contraction, which is why I don't own Microsoft, because at 32 times earnings, Microsoft is priced to some kind of perfection, where if everything goes right, 32 times earnings is fair. But if the growth pulls back, if something happens, if something comes up, the company will experience a multiple contraction, which is why I'm not willing to pay for Microsoft more than 28 times earnings, so around 28, 27, 28. So I wouldn't pay more than 28 times earnings. In this case, if I'm buying Microsoft at 28 times earnings, I just have some kind of margin of safety where, multiple is not going to go to 24, 23 times, highly unlikely. So 28 times would be some kind of margin of safety in case the growth was slower, in case of something goes wrong. I will not experience such multiple contraction. And 28 times earnings would equal $365 per share. This is forward earnings. $365 per share, what is 13% decline from here, which in my opinion isn't unreasonable at all. It's very, very possible. Those companies, they go down 10, 15, 20%, and they go up 10, 15, 20%. So 30% could happen. Maybe it doesn't, but this is my mindset. Is I'm not dying to own Microsoft. I have my stocks. I would rather add to my own companies. But if I do get my Microsoft at my price, then okay, I'm gonna buy it. But I'm not gonna FOMO in Microsoft because I'm just dying to have exposure to AI or whatever. I don't have those feelings, I can patient. I can wait. If it gets to my price, I set my price alert. Okay, it gets to my price. I look at it again and I might buy a small position. But if it doesn't, it's fine. I can let it go. I'm not going to cry about it. And I just move on to another one. There's like 3,000 or 4,000 stocks, and you'll always get different opportunities. So that's my thesis with Microsoft, and I'd love to buy it at 365. The second one, which I've been waiting on for a while, and I keep waiting and I keep waiting, and it's just not going down. It's not going to my price, but it could very soon. It's possible. And this is CP, Canadian Pacific Kansas City. CP is an amazing company. A lot of you know that I like this company. And I always had something for railroads. Like, I like the railroad business model. It's just an amazing one, and it's something you can't replicate, you can't rebuild. They have a wide moat in terms of the network. And it's going to be here 10, 20, 30, 50, 100 years from now. Buffett likes it too, and I like the railroad stuff, even though there's some CapEx involved. But I like it. I mean, I love the business model. I used to own UNP before, back in 2016, and I sold it like an idiot. I should have held that stock. But yeah, that's how you make mistakes, you learn. And I like CP very much. And I'm going to tell you why I like CP over other companies. But the stock has been all over the place. And very recently, it's been declining, mainly due to potential tariffs from Trump on Mexico and in US, on Canada. And the thing with CP is I believe it's the only railroad network which connects Mexico to the US, to Canada, all in one railway or all in one kind of network. I believe it's the only railroad company that has this network. And if Trump wants to put in 25% tariffs on Canada and Mexico, it's going to hurt exports a little bit. But in my opinion, this risk is massively overblown. First, because maybe he's using it as some kind of a negotiation tactic for some things on the border and some things with Canada, so they can buy more US stuff or something else. I don't believe those tariffs will be implemented. But if they were implemented, it's still going to be cheaper to import stuff from Mexico than it is to make it in the US. This is just the truth. This is not going to stop the trend that's been happening with Mexico being the largest trading partner of the United States. I don't believe it's going to affect it a little bit, of course, but it would be a massively overblown thing. And I hope it gets more overblown. I hope the concern increases so CP can go down and I could get to my own fair value so I could buy it and hold it as a very long-term investment. Now, the good thing about CP is in terms of accidents, they have the lowest accident frequency. And this is important because you remember what happened to Norfolk Southern and I believe Ohio it was, and a few other places. And if you have a lot of fatal accidents and other things that happen, it would be bad. You could get sued. You could have a lot of lawsuits, and your fair value changes. The balance sheet gets messed up. So it's a good company in terms of safety, and that's that's very important. Now, if you look at CP is trading at 21 times earnings, and this is expensive. But immediately, the first comment I get is people tell me, why would you like CP? Look at, CSX. CSX is trading at 18 times earnings. Look at Norfolk Southern is trading at 19 times. Look at those other railroads. CP is overvalued. Well, again, investing isn't so simple. The main reason CP is more expensive than Canadian National Railway and is more expensive than those stocks is because the companies, the management, guidance, and even the analysts, they're guiding much higher adjusted earnings per share growth, double digits core adjusted EPS growth. And I believe it will likely be around 14 to 15% EPS growth because there will be a lot of synergies, a lot of different things they can benefit from this unique network that's impossible to replicate. So they have much higher growth than CSX, they have much higher growth than CNI, and they have a very different network with very little competition in certain places. And this is why CP, Canadian Pacific Kansas City, is trading at a premium compared to CNI and CSX and Norfolk Southern and Union Pacific and all these kind of railroad companies. But for CP, I'm just being honest, 21 times, isn't cheap, but it's not expensive either. But it's, again, not where I want it to be. Like if I want to buy CP, my fair value for a small position would be around $70 per share, which is a 6.5% lower from today's price. And I believe 6.5% is easily achievable. If it gets to $70 or below, I would have some kind of margin of safety in case the growth wasn't mid double digits earnings per share. Maybe it was low double digits, or maybe it ended up being high single digits. And a lot of stuff could happen. But I really like CP. If it gets to $70 or below, I would buy it and hold it for the very long term. This is a buy and hold forever kind of investment. And I just want to remind everyone that if I told you I'm going to do something, it doesn't mean I'm going to do it. Because maybe Microsoft gets to 365, but then I find a much better opportunity. I might skip Microsoft and buy something else. So if I tell you something here, it doesn't mean I'm 100% going to do it, because I evaluate stuff based on the environment, based on different opportunities available. And that's why I have my own investment group, and I share everything I do in real time. If you want to get notified, you click the link over here. You could join and find out what we do. And we've been doing amazingly well. And I believe 2025 will be better. And this is just my opinion on Microsoft, CP, stocks I want to buy at the right price. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.